Hi, Paul. How are you?
Jack, I am fine, and thank you so much for inviting me to join you and the people who are following your work. I really do appreciate it.
Thank you so much for accepting my invitation. It's a great honor to me. Could you please introduce yourself, especially in the context of your investment career? I know that you're very well known in the industry. You're a legend, actually. But if you could just, for those who are really new to the markets, if you could just tell a few words about yourself, who you are, and about your investment career.
Well, it is interesting that you comment that I'm a legend because the reality is I'm a teacher. And I have spent my whole career since the 60s, 1960s, basically teaching people what I was learning about investing. And I will tell you, Jack, that what I teach today is very different from what I taught in the 60s. But I was around the industry in the 60s as a stockbroker. And it didn't take very long for me to figure out that there were some huge conflicts of interest. And so I left the industry and went out and did a number of other things from about the age of 23, 24 until I was, I guess, about 40. And then I mean, we talk about the FIRE movement and how people want to retire early. I didn't think of it that way, but I actually had accumulated enough at that point that I could at least theoretically retire. And so I retired and I started all over. And I built a business offering not only teaching and teaching people how to do everything on their own, but if you didn't want to do it after you learned what you should do, I was happy to do it for you. And I really have to laugh because when I sold my ownership in my company in 2012, I think we had 1.5 billion plus under management. But when we started in 1983, we had nothing under management. And I had no idea I was going to build an investment advisory firm. So my minimum investment that I would help somebody, you had to have at least $2,000. And I charged you 1%, which meant that I was willing to work for you for a year for $20. So it was not a business model built to make anybody any money. But over time, people came to work with me. And as they did, we had to run it more like a business. But we never, ever gave up on the dedication to teaching people how to do it on their own. And then when I retired in 2012, I was unemployed for a few moments, maybe hours, and I had started this foundation, Merriman Financial Education Foundation, where we again teach people how to do this all on your own. But there are two things that are different. Number one is I don't make a penny. That's part of the deal. I'm not allowed to make any money here. And we're not teaching so that people can become a client. We're teaching so people really either are going to be a better client for somebody else or really learn how to be a do-it-yourself investor.
Thank you, Paul, for all the work you're doing for us for so many years. I really appreciate it. And by the way, on your website, there's so many articles and so many materials. I just don't know how you do it and how many hours you sleep per day, but it's just wonderful. But I'd like to use your great experience, which you gained over the years, because you basically have like over 50 years of investment experience, or you were on the markets also like for more than 50 years. Do you think, and by the way, I have so many questions today, so I apologize in advance. Do you think that the markets as such changed during that time? Is there maybe on the other side and anything that doesn't change? How do you see that?
Well, the market has changed a ton. The bottom line is that today investing is so much more efficient than it was when I started in the mid 60s. And it's built so it's in the favor of the investor That is a change, because in the 60s you had an 8.5% load on almost every mutual fund, including bond funds, if you can believe it. In fact, when money market funds first came out, they tried to put a commission on those money market funds. But of course, the public said, no way, we go to the banks and they don't charge us a commission to put our money away. Why should we pay you? And they quickly adjusted. That's one thing about Wall Street. If something's not working, they quickly adjust. And so today we have the index funds. We didn't have those when I started. Today we have commissionless trades. We have trades that the only real cost is a spread. And today the spread is not regulated as it was back in the 60s. And commissions are not regulated like they were in the 60s. And by the way, early in the 70s as well. So it is a whole new world for investors. The problem is that the emotions, I think, of investors today are very similar to the emotions and those challenges when I came into the industry over 50 years ago.
Okay, so we'll get back to these challenges, emotional challenges, because this is a big topic. But then I assume that obviously when you started in the 60s, you couldn't start as a passive investor because there was no such idea broadly known at that time yet. So you had to start as an active investor for sure. And then how your career was evolving, how you were evolving as an investor, how your philosophy, how your approach to the market was evolving over the time.
Well, I want to go back to the early thing you said there about active management versus passive. There were a lot of passive investors.
Okay.
In fact, today we would probably see them as do-it-yourself investors, because what they believed was you take the time to find 10 or 15 or 20 stocks and you invest in those stocks. You take the actual physical certificate, you put it in a lockbox, and the idea was you leave it there until you retire, and then you start taking out shares and liquidating them to pay for your retirement. And I have friends that are still doing that. They've been doing it all their life, and it is as close to a buy and hold as an investor that I know, because it is even less volatile than what an index fund would do. And so, yes, it did. But Wall Street didn't want that. Wall Street wanted activity, and that's where they make their money. So it is a tug of war for Wall Street, because they want my friends to sell out and go do something with that money and give us a chance to make a commission or something. But my career, after I left the brokerage business, I was in it less than 3 years as a salesperson, and I did not do anything in terms of investing for the public, except that I did some venture capital work and helped some small companies get started. And then eventually, and by the way, one of the things that happened to me, I love the randomness of life, Jack. When I was going to school in New York, and I went to a school while I was working for Harris Upham, which eventually becomes part of Smith Barney. So I was working for a New York firm, but while I was there going to the New York Institute of Finance, which is a fancy name for a sales training program, I met a fellow. His name was Sam, and Sam was a fellow who was in his mid-60s. I was a 22-year-old kid, and he was in his 60s. He had been a believer in market timing with point and figure strategies for decades. And he had retired from running a drug company in the Chicago area to become a stockbroker at age 65. So he was in New York and a married guy. I was in New York and a married guy. Sam sat down and taught me point and figure. So I had my first serious introduction to what we would call market timing early on. And I was always attracted to that because my nature is to be defensive. I look at everything that we do in educating people to be better as an investor as a defensive step, whether it's lowering expenses or lowering turnover or lowering taxes or lowering investment management fees. Every one of those steps is one of defense to keep more money, hopefully, we never know, but hopefully in your pocket. And market timing, I did not see it as a way to make more money. I saw it as a way to protect against losing money. And if you look at that period from the mid 60s through about, I don't know, 1982 or 83, people who invested in the market, many of them didn't make any money because they got caught by one market decline after another. And you had all the people who sold out at the bottom of those declines. And there were tons of people that had not been successful. And yet those people who really bought and held, they did okay if they bought and held the right asset classes. So there were lessons there, and then there were lessons about market timing. So I come into the money management business in 1983, just after we've been through this very long period where people didn't use defensive strategies. And if they had used defensive strategies, they would have done okay. They wouldn't have gotten rich, but they would have made reasonable rates of return. And then I started business. And at that point, what I was doing was market timing. I was telling people when to move. In fact, we had a service. You would like this, Jack. We would call you. You would pay us an annual fee, and we would call you and say, we're moving, and here's what we're doing. And people would do that. And many of those people found out they couldn't do it. And so they hired us to do it for them. And then about 10 years later, we had a lot of clients that we were doing that for who had other money that was more traditional buy and hold kind of money. And they were asking us for help with that as well. And so we added that to our practice. So we showed people how to market time. We showed people how to buy and hold. In fact, I used to do a 6-hour workshop, 3 hours on buy and hold in the morning, 3 hours in the afternoon on market timing. And people would walk out of there and say, what does he believe in? It was confusing to people. And in fact, I believed in both. But as I spent more time in the trenches with clients and with students, I realized there is a huge difference between the ability to make buy and hold work for a lifetime and to make timing work for a lifetime.
That's fascinating what you are talking about in the respect of active and passive investment, and I will go back deeper into that in a while. But quite often you are saying in your podcast also that you are a big fan of using academic scientific knowledge. And you mentioned that, for example, Wall Street was not that interested about passive investing because obviously the commissions are lower paid to them. But someone may ask, on the other hand, why not use the knowledge of Wall Street because they are practitioners in the end? So why you are such a big fan of academic, scientific approach? Quite often you, for example, refer to Professor Fama, Professor French papers in your podcasts.
Well, I guess what we have to ask ourselves is, what does the evidence show? What is the evidence that says that Wall Street works on our behalf? First and foremost, like a fiduciary, somebody who always does what's in your best interest. That isn't true. And there are all sorts of ways that I can make that judgment about Wall Street. I've got a free book at my website entitled Get Smart or Get Screwed, How to Select the Best and Get the Most Out of Your Financial Advisor. And in that book, I have 80 reasons why I don't trust commission-based salespeople. I don't mean they're not nice people. I don't mean they don't make good dads and friends and whatever that, but they come with a conflict of interest that I think, as we think about what are the challenges of individual investors with the investing process, you might also ask, does a broker have some of the very same challenges? Because it even mixes in then their compensation, not only making decisions of what to buy and sell, but then how they make a living. And I just intuitively see enough fines being paid. I mean, always these big brokerage firms will not admit guilt, of course, but they're paying these multi-million, sometimes multi-billion-dollar fines. Where do they get the money to pay those fines? Out of our pockets. So just intuitively, I don't want to count on them to take care of my money for the rest of my life, nor do I want that to be the decision-making process for others. But what I do trust about the academic community is a couple levels of trust that are built in. One is their job is to do real research that is in the best interest of, in a sense, of the investor at the end of the day. And then when they do that research and they bring it to their peers, they are then open to criticism from their peers. And the peers love to pick them apart if they can, because there's a kind of competition going on there. Because the people who have come up with the best research, if you want to look at it that way, those are the people who have become the most famous and maybe even found a way to cash in on it. But the bottom line is, intuitively, that process of what they go through to determine what's in your best interest, I think that's more trustworthy. And by the way, they will readily admit they can't tell you the future. Fama and French can't tell you the future. They can tell you what the premium for small cap value has been in the past, but they can't tell you what the premium will be in the future. But I tell you what they will tell you is they believe wholeheartedly there will be a premium for small and a premium for value. It isn't magic, just like there should be a premium for equities over fixed income, but not always for very long periods of time, whether you're looking at bonds versus stocks or large versus small. And they help us understand that. They don't hide the bad news. They reveal the bad news, because that bad news is what an investor's going to have to go through to get from point A to the end of their life. And we need to prepare them. The academic community, I think, does the best job of preparing them for the reality of successful investing.
Investing is an important aspect of our lives, that's for sure. But what else, in your opinion, should we do to feel satisfied and have a happy life? Because, for example, when I look at you, it's so amazing that you are so active and you are having such a big passion in educating people. And really, I just enjoy talking to you. Is this maybe a recipe for a happy life, just being active and having a mission? And I was reading, and by the way, I will return to that later on, to your discussion to Jacques Bogle you had a few years ago. And after that, when you were commenting that meeting, you wrote on your blog that, and I just will quote it, "I have always thought I would continue my work until I'm 85, but seeing Bogle and how much he obviously loves what he is doing, I'm now committing to continuing until at least age 90. So is it just a recipe for a happy life, just being so much, dedicated and have such a big passion and just educate people and do what you love?
Well, something, to be fair, I'm retired. And as a retiree, I have lots of other friends who are retired. And I get together with them often. And some of those people look at their success in retirement as being built on three legs. Leg number one is family. Leg number two is friends. Leg number three is golf. Okay?
All right.
Now other people have, I find, those same two first legs, But that third leg is something else. And I don't know if the reason I spend all the time I do on a financial education is because I love it or because I can't play golf. But I will tell you that there is a great feeling when you're doing something to help others. My mother was a nurse, and she spent her career helping others. She used to go in on weekends with her doctor, and they would they'd let people, this goes back before Medicare, they'd let people in the back door to come in and get their help with their health at no cost. She just had a commitment to helping others that it was a great lesson for me. And she also, by the way, never failed to remind me, be nice to everybody you meet in your life. And she said, you never know how they're going to change your life. And by the way, that has absolutely been true. But the passion for teaching, it's what I know, Jack. I don't know anything else as much as I do this. And the reality is, you said it earlier, money is a part of everybody's life. Exactly. And the fact is, if people can get that right, they are going to solve one of the major problems in marriages, and that is problems around money decisions. And they're going to be able to retire with dignity, and they're going to be able to leave more to others. And I don't mean they have to have a job that pays them $1 million a year so they can invest 100,000. I mean just the people who can find ways to put away $5,000, $6,000, $7,000 a year eventually as they grow their income. Everybody can do this as long as they don't do too many things wrong. And I don't want them to make the mistakes that most all of us have made. I don't know what your mistakes have been, Jack, but I can tell you I did a whole bunch of things early on that I wish I could take back. And I'm trying to help young people. I have this weekend, I have a high school group on the East Coast that I'm going to be doing on Saturday and teaching them. And then next week, I'm doing a university group of kids. And I want to help them, and we have ways to help them, but then we also want to help the people who are retired, because they too can take steps to take better care of their money.
I wanted to talk now about the behavioral challenges and aspects of investing, because this is what everyone will face it once we invest any money. So how do you, for example, control your emotions when it comes to investing? Or what would you recommend also to others in terms of managing our emotions? Because this is a big part of the whole process.
Yeah, it's a tough one. It's a tough one for me. I made a brilliant decision years ago. I mean, I cannot tell you how happy I am that I made this decision. I made the decision that as I looked at my own personal response to the market and to my investments, that I was probably smarter to have somebody else do it rather than do it myself. I am happy to teach all day, others to do it on their own, but I know myself. And because I am defensive, my mind is defensive at all times. When the market starts going down, if I don't have somebody there taking care of it, I probably would overreact like so many people do. So yeah, there's a price to have somebody take care of it. And it's a price, by the way, that over a lifetime can be worth millions and millions of dollars. I mean, there is a payoff for learning how to do this yourself that is just huge. On the other hand, if we make those bad decisions, panic when the market is down, not want to invest when the market is down, forget about panicking and getting out. Some people just stop investing when the market is down, the very time that they could be buying more shares in terms of the price they pay. That will, from everything we know about the past, you'll get a reward for that later. And the cheaper the shares you buy in the first place, the bigger the reward later. But it's a difficult hurdle to get over for a lot of people. I don't know if you look at the numbers, Jack, but at least in the US, something like 25%, and I've even seen numbers up to as much as 40% of millennials will not put any money in the stock market. They do not want to take the risk. They look at investing as just one big crapshoot. It's a gamble, or it's just a massive speculation. And then they can just be crazy and conclude, by the way, the same people can be crazy and conclude that cryptocurrency is a safer place to put their money than the S&P 500. I mean, these kinds of interesting thoughts that people have, I shouldn't call them crazy, but people come to conclusions about investing that there is no evidence that they are right. But it's what their heart or their gut or their brain is telling them. And by the way, the academic community has figured this all out, and they have a whole list of biases that people have that stand in the way of their investment success. And at the end of the day, if we can figure out how to manage each one of those biases, which is what I'm trying to help people do, they are likely to be successful. But if they don't know those biases, how will they identify whether that might be the reason they don't achieve what they want to achieve? Self-awareness in this business is absolutely huge. And so I know me, but I'm 78, so I've had time to know me. And young people don't have much time behind them to know themselves and to understand the investment process. But the sooner they get it, the more likely they are, and I'm talking about the market as well as themselves, the sooner they are to be a success.
So how do you think an investor should adjust strategy so that it's really matching his or her, let's say, psychological construction? Because I think it's a big part of the whole process, because people quite often, the beginners, they have funny expectations about what they can have on the market. And these expectations may be leading to the wrong decisions. So how, for a novel investor, to have realistic expectations, how to approach that problem?
Well, let me talk about the 7 things that we do on our website, because they are aimed at helping people get through those decisions and understand them. We do not give tax advice. We do not talk about Roth IRAs and 401ks in terms of all the legal aspects of it. We are not financial planners. We are not estate planners. We have focused in on the area of understanding and learning what equity asset classes you should have in your portfolio, because for 99.9% of folks out there, that is the gas. That is what's going to give them the growth to have the money that they're going to want later on. The second thing is, once you understand what those equity asset classes are, and not individual securities, I have no idea how to do that, but rather broad, big companies, small companies, growth companies, value companies. There are ways the academics have broken these out that it's really easy to understand the past. Then we want to know how much of each one of those should you have. Then we want to know how much should you have in fixed income to go along with the gas, the bonds. That's the brake. The bonds are not trying to make you rich. And as a matter of fact, they're keeping you from making yourself rich if you have all in bonds and no stocks. So what's that balance of equities and fixed income as an investor? We have built tables. They're called the fine-tuning your asset allocation tables. They show all S&P 500, 100% in S&P 500 from 1970 to 2020. At the other side of the table, on the left-hand side, is all bonds, breaks at all times. In between in 10% increments. We show a combination of more bonds and less stocks, so that you can look at 10% in equities, 90% in bonds, 20% in equities, 30, 40, you've got the idea. And at the bottom of that page, you will learn, okay, had you done that with the S&P 500 since 1970, here's how much you would have made with each one of those combinations. But then below there is the other part of the formula. Not only how much you make, but how much did you have to lose? I have stood in front of thousands and thousands of people, tens of thousands of people, and I have said, I don't mean in one room, by the way, I have said, if you follow my advice, I guarantee you will lose money. Absolutely guarantee it. And then the people will laugh nervously. What do you mean you guarantee I'll lose money? And I said, well, because part of the process of investing and taking the risk of bonds or stocks, sometimes you lose. With bonds, it's teeny tiny amounts of losses. With stocks, it's huge. It can be, if you look back far enough, it can be 80 or 90% of the value of the securities. As a matter of fact, if you have all your money in General Motors and it goes broke, or in Washington Mutual or in Eastern Airlines or a whole bunch of other companies, you lose everything, which is why we don't want you in individual companies. But that table helps you understand what you're going to have to go through. So I could ask somebody, how much are you willing to lose? And they say, well, I'm willing to lose 20%. And I'll say, okay, it looks to me like you should be maybe 50% in stocks and 50% in bonds, because you're likely to lose that much. And in fact, if you do that, I can almost guarantee you lose that much. And they'll say, guaranteed? Yeah, I don't want to lose that much. That's the tug of war people need to go through. But they also need to find out, what amount of exposure to risk do they need to reach where they want to go? Well, that's going to depend on how much they put away. And all those kinds of moving parts. We do our best to show people historical information, in some cases going all the way back to 1928, so that they will see that either how much you make, how much you lose, how long you don't do what you expected. You talked about expectations, Jack. People's expectations are, if you go into stocks, you're going to make a lot of money real fast. Yes. And sometimes it can take you 20 years to break even. I mean, that's the two sides of that stock portfolio commitment. And so I'm trying to educate people to have the reality. And in some cases, it causes people to be less aggressive than they might have otherwise. And what I don't know is if I've just hurt them or I've helped them. Because maybe if they had taken that greater, more risky path, they would have stayed the course. They wouldn't have cashed in like so many people do. Or maybe it will be the reason they don't cash in, because they figured that out and they accepted that risk on day one. I'm going to be dead and buried before these people find out if what I recommended was really the best thing for them. But I'm trying, and that's all we can do. And that's the same path you're on in your work.
And do you think that an average person can run their own investment, or should rather find someone, delegate that to services like, for example, robo-advisory, or someone like even you, as you said, you are an expert in investing, but you prefer to have someone who pulls the strings? I mean, so it's following the strategy you set, but do you think that an average person also should try to follow that path?
Well, I want to make one thing very clear in my portfolio where somebody's taking care of it. It's very complex. It is half in buy and hold with 10 different asset classes in equity, and then the right amount of fixed income, and rebalancing and taking money out to pay for our retirement, because I don't have a pension. This is the money that we live on. And then the other half is using an active strategy called market timing. And again, that's something that I would never be able or willing to keep up on a regular basis. So I want to be careful that mine is very complex, but it's what I want. On the other hand, there are very simple strategies that you can do on your own. In the book that we recently wrote last December, published called We're Talking Millions, 12 Ways to Supercharge Your Retirement, we talk about a bunch of important decisions that you make. But number 12, $1 million decision all on its own, is to use what they call a target date fund. Now, when you buy a target date fund, what happens is you, in essence, have a robo-advisor. You have a robo-advisor who knows that you want to retire in 2065. That's great, because that robo-advisor, they understand the kind of risk you should be taking. Now, they're probably going to be a little more conservative than I would like, but certainly they would be right on spot with what a John Bogle would like. And so they would have mostly in stocks. And then as they get older and older and older, at some point they add more bonds and more bonds and more bonds, so that when you get to retirement in 2065, according to these professionals, and they manage trillions of dollars. I mean, it's not like these are people just getting started in the business. They know what they're doing. Now, by the way, they don't know the future either. So they know what they're doing to do what they think is the basic right thing for you. And I'll want to differentiate at some point here, if we get a chance to, Jack, between what John Bogle wants for people and what I want for people, because it's different. But those target date funds allow you to let somebody else do it. And you know what you have to pay? About 0.1% a year to as much as 0.15% a year. When I was getting started out and you had to buy a load fund and 8.5% was lost immediately, and then the expense ratios were about 1%. So for the rest of one's life, there'd be taken out 1% every year out of your hide. And you started with 8.5% less than you should have in the beginning. Today, you buy the target date fund. They do the right things, right in quotes, because any two advisors could easily argue what's the right thing. But yes, you can do it on your own. And what I in our book about those 12 ways, one of the things we talk about is taking that target date fund, adding a little smidgen, a percentage. Put 9% of your money in the target date fund. Put 1% of your money in another fund, a small cap value fund, and it could increase over your lifetime anywhere from 25 to 100%. What you will have to spend and what you'll have to leave to others. So, and that would mean you'd have to do one thing every year. You'd have to divide your money. You put 9% in one and 1% in the other. So now you're investing in two funds instead of one. I think you could do that. Yes.
So let's talk a bit about active versus passive approach, because I see some people are, like, I would say, dogmatic. They are telling, for example, that only passive approach is the only way we should go. And personally, I appreciate the idea of buy and hold and being passive, but is it really a big sin to use market timing strategy? I know you are doing that, so obviously this is not a big sin because you are an expert, but do you think that in general market timing is working and you would recommend that for even an average investor, or you think that the passive approach is better?
Well, first of all, I wanted to take a stand here so that people understand market timing is something almost everybody in the industry does. When somebody says, you know, I think you should be getting out of those long-term bonds and moving into a short-term bond because interest rates are going to go up and the long-term bonds are going to go down, Market timing. I think you should probably, you know, the small cap value's been doing well lately. Maybe it's time to move some money out of that large cap blend fund and put part of it over here in this small cap value. Market timing. People say, look, take some money off the table because you're going to have a chance to buy some of these stocks cheaper. Market timing. Every one of those pieces of recommendations, those are all market timing decisions. Now, the fact that one like myself would say, well, my kind of market timing is that I watch the trend. And by the way, somebody's doing it for me, but they are watching the trend. And when the trend changes sufficiently to call it a chance, opportunity to protect against further loss, you move out of the fund and you move to a money market fund, waiting to get back in later when the trend changes to the upside. Now, when you tell the market timing story, it's very easy to say, well, yeah, that makes sense. Why not? If you can do that, why not do it? Well, here's the reason so many people struggle with it. I'm going to tell you that professionals struggle with it too, because it's not unusual for professionals to second guess their own systems. The system will give a buy and a sell, and you, whether you're an amateur or you're a professional, you think, yeah, I can see it saying I should be getting out, but did you see that release of unemployment yesterday? It was fantastic, and there's all that money about to go into the economy. No, I don't. I want to override that for right now. I can always take care of it later if things get any worse. The minute you are second guessing a system, you are no longer an automated system-based market timer. You are just like everybody else guessing what's going to happen next. And in the process of using these mechanical systems, boy, you know this as well as I do, Jack, you're going to have many times you'll have losses, multiple losses in a row with a system. You will sometimes get out of an investment at a price lower than you got in. Whoa, I don't like that. And then you'll get back in at a price higher than you got out. Whoa, doesn't that mean I have fewer shares than I had? Yes. And there'll be times that you have a major market decline, and that system, while it may protect you from part of that decline, you still end up with a loss. And you somehow thought that magically somebody had a system that you would never have a loss in a bear market. You know, the expectations are just as wacky for people who look at market timing and come to judgments as to what it will be like as buy and holders. The difference is this: the buy and holder never has to do anything. And there's a chance that will work. But with market timing, every day you get up, and theoretically, even when you're using systems that don't trade very often, you at least have the responsibility to consider, what does the system say to do, and then to do it. So okay. I'm just saying, Jack, that my concern is most people won't be able to do that. And I really respect the kind of work that you're doing and trying to help give people the data that they need and the ability to test systems. But they have to have the ability to actually do what the systems say to do one day at a time.
Thank you, Paul. I'm personally a quant, and to me, market timing means following a mechanical strategy, because yes. To me, discretionary approach wouldn't work because I'm too emotional. I would just do stupid things. So even sticking to the strategy is not a simple thing, but this is the only way for me. And by the way, do you think that once we are talking about this, do you believe that there are good discretionary investors, market timers, who are taking decisions just based on their discretion, based maybe on their experience, rather than on some rule-based system?
Well, first of all, I will tell you that people who do it professionally have some of the same problems. I think I mentioned this earlier. They second guess. If a system stops working as expected and has several losing trades in a row, people get nervous. And in the process of getting nervous, they think, well, maybe I should find a better system. Let me guarantee you, and you know this oh so well, that if a system hasn't been operating well lately, that you can go in and find a system that handled that market better than the one that you actually used. And while this seems kind of a questionable thing to do, it is exactly what money managers do who pick active managers to manage for pensions. What they do is, if somebody doesn't perform well over 3 years, they say, well, we got to do something about that. And I've done an analysis, and here's a firm that did better. And I want you to get out of the bad firm and get into the good firm. What they don't tell you is studies show that when you get out of the bad firm and get into the good firm, you don't do 1 penny better on average. And so it's just a way of looking busy and acting as if you are earning your money. But they know better in almost every case. Here is one of the things that I did that was a major change in the money market, in the market timing business. Back in the 80s, early on, I started using other market timers. I hired other timers to use their systems. And the idea was that I would use many systems rather than one. Now, I wouldn't do majority rules, and if 3 out of the 4 are in, then that's the time to be in. And then when one of those sell, you get out. I divided the money into 25% increments and had 4 separate market timing systems, all systems that had worked in the past. This is not so different from having large cap and small cap and value and growth. It's the same kind of diversification. And as we did that, we then were, to the best of my knowledge, the first market timing organization to not only have multiple market timers, but to bring in international and small cap and large cap. So we were market timing a broadly diversified portfolio. By the way, my old firm still does that. And they do it for me, I'm happy to say. But the bottom line is that you, with market timing, can use multiple systems. But my recommendation is to let them each stand on their own, because they're based on a different set of historical kinds of outcomes that somebody believes that those system trigger buy and sell signals are going to help you. And that is something that we did that I think a lot of people copied after we did that. But it makes sense to me, particularly when I look at my buy and hold portfolio, does the same thing, has small cap value and large cap value, but not market time.
And by the way, you mentioned in one of our emails exchange that one of the strategy, market timing strategy, has a great track record. I'm not sure if I remember correctly, around 14% or something for the last 3 decades, around 3 decades. What type of strategy it is? Is it a trend following, or if you can tell us a bit about that strategy?
Oh, sure. Oh, no, I think it's, I was there to start it in 1995, and then a person joined our firm, an engineer in 1999 or 2000, but he took that hedge fund over and has just had a wonderful track record. And here's what it does. I don't believe that market timing is going to get you a better rate of return. I believe that market timing, in fact, I believe that it's guaranteed that if you spend part of your time in a money market fund and part of your time in the market, that you're going to have lower volatility than if you're always in the market. That part is guaranteed. What isn't guaranteed is what the return will be by doing that. And in many cases, the return is lower. And in some cases, the return is higher. I got a lot of TV time. In fact, I was on a show you maybe never saw, Jack. It's called Wall Street Week with Louis Rukeyser. And I was a special guest one week. And it was because all of our money was out of the market during the crash of 1987. That's the good news. The bad news is I did not call the crash. They wanted people to believe I called the crash. But the market timing systems I was tracking all were out of the market about a month before the crash happened. I didn't call the crash. The crash happened while we were out of the market. But it got me in front of a whole lot of people who wanted to know more about market timing. I hope that good luck happens to you someday. It does make a difference. But gosh, I got thinking about that. And go back to your question one more time. You remember what you asked me, Jack, when I went off on the Wall Street Week?
So basically, regarding that strategy with a great track record, is it a trend following? Because I believe that you are a trend follower, or you like, I think, that type of strategies, at least from what I read on your blog posts or on your podcasts.
I'm sorry. Yes, what I was about to say is my sales pitch for timing was not about making more money. It was about taking less risk and hopefully getting a decent return for exposure to equity holdings. What the Leverage Global Opportunity Fund does, it combines market timing, defensive, with leverage.
Okay.
And so, and there was good evidence, by the way, because in 1987, we were being tracked by a fellow named Mark Hulbert, the Hulbert Financial Digest. And we had accounts or strategies that they were tracking that were up over 50% in 1987. And that's because there was leverage in those accounts. And then we got out and then the market collapsed. So we looked like geniuses. Nobody is ever a genius. You know, the market makes you money. You don't make money, the market does. And we had the good fortune, like a lot of money managers do from time to time in their life, that makes them look better than they really are. But here's what I do know. When you combine market timing, traditional trend following, and sector rotation for a part of the portfolio, momentum kinds of work. And we have many different strategies. Sometimes we'll have 100 funds in the portfolio. And we don't use a lot of leverage, but enough leverage that it does make a difference. And it's just had a wonderful track record. And a lot of people don't know this, but most hedge funds don't live past 10 years. Most of them are out of business within 10 years. So to have been around since 1995 is a pretty doggone good track record. And by the way, the money made, the downside risk, you'll appreciate this, the downside volatility is about the same as the S&P 500. But the return over time is about, I'm talking about compounding, is over twice the S&P 500 since 1995.
That's impressive. That's impressive. So now I hear about Bogle heads, and I also quite often hear about Merriman heads now. I wanted to, if you could tell us a bit more about your conversation with Jack Bogle you had years ago. How is Jack Bogle's philosophy different from yours, if at all? Maybe it's about diversification. How do you see that? And if you could just tell us a bit about that conversation you had with Jack Bogle.
Well, when you ask me this question, I'm telling the truth. I get goosebumps because it was literally, it was a really special time. I was programmed. I had an appointment for an hour in his office, and And so I got there and he gave me 90 minutes. Uh, he was, by some, I've heard that he can be gruff, particularly if he thinks that you're not straight or there's something about you not to be trusted. But he was really nice to me. There is one huge difference between John Bogle and Paul Merriman, but let me tell you what I think is the same. He really, his focus was on helping the masses. As we know, Vanguard has some $7 trillion plus under management. A lot of that is for very, very large institutions. But the big institutions didn't seem to be on his mind. His mind was on the smaller investor. And what he wanted out of the recommendations that he was making was that people would have enough. And I believe that what he was professing to be the best path, the glide path that the target date funds have, are based on taking a moderate amount of risk and conservatively changing that balance of fixed income and equity so that if you do that over a lifetime, and we've looked at this carefully, you have a legitimate shot over the, let's say, from age 20 to 65, an 8% compound rate of return. Now, that is a very fine rate of return. And by the way, you're going to make more money in the early years. You're going to make less money in the latter years. And probably if you do that for 40 or 45 years, you'll be okay letting them go on and do it for the rest of your life because they'll do it for the rest of your life. In other words, you need to make one decision. That's it. I mean, that's pretty amazing to think. Most people over their lifetime, they change their portfolios 3, 4, 5, maybe even 10 times before they finally find something they feel like is a long-term strategy. Well, the basic difference, and by the way, John was very critical of my work, not because I believe in having 10 different asset classes. He agreed with all that Fama and French research. There was nothing wrong with that. His point was it was too complex and that people are not going to follow a strategy if it's too complex, which is why we developed the 2 funds for life strategy. But where John Bogle and I differ is I'm not trying to build enough. I am trying to help people build more than enough. And I want to give you an example. Most people don't have enough. Let's start there. Most people do not retire with enough. There are a lot of people that all they have is Social Security to live on. And if that's enough, I'm feeling badly for them because that's a tough way to spend 30 or 40 years after retirement. But what I do believe is if we can save enough plus, see, John would like them to get, I mean, from the conversation, this is what I'm gathering. You get to retirement and you're able to take out 4% a year and adjust it upwards each year for inflation, and that you'll have enough to last the rest of your life. You may not have much left over. In fact, you could be, broke at the end of a long life, but it should give you enough. There's a whole other level of how much you could have at retirement. It could be 125%. It could be 150%. It could be 200% of what you need. I kept working for money longer than I needed to, but part of what I wanted, I wanted to have way more than enough so that it wouldn't be a 4% extraction rate. It'd be a 5% extraction rate. And instead of having to adjust to the distribution based on inflation, don't even worry about inflation. We're already taking out more money than we need anyway. So if instead of $1 million, taking out 40, If you've got $1.5 million, you can take out 5%. You can take out 75, even though you only need 40.
Yeah.
And I want to help people get to the $1.5 million. And by the way, a whole lot more than $1.5 million, because by the time that people get to retirement 30, 40 years from now, I'm just sure, based on the past, that inflation is going to cause you to want to have not 1 million or $1.5 million, but 5 to 7 million. I'm not kidding. 5 to 7 instead of 1 million.
I have a great respect to Jackiem Bogle's achievements, but also I think that he was quite lucky that he started his index funds in the middle of 70s, when there was like 25 years or something, there was a like 17% annual compounded return on S&P 500. If he would start, let's say in 2000, when there was a dot-com crash, probably the whole story would look different. Would you agree with that? That
Totally.
On top of the great work he did, he was also quite lucky.
I brought that up when we met, by the way. Yeah, and I was serious, because I've had many things happen that we have to grab the luck that we have a chance to take advantage of and do what we can with it. He understood that totally. He also understood how close he came to not having anything in terms of the greatness that he achieved, because he had started the 500 fund after having been terminated by a company, and he was looking for a way to make his mark. He was not the first person to come up with the idea of an index fund. As a matter of fact, Malkiel, in his original first edition of his Random Walk Down Wall Street in 1973, discussed exactly what the S&P 500 fund ended up being. I mean, it was word for word what it ended up being. And on top of that, they come out with the S&P 500 fund in 1976. They expect to raise 150 million. They raise $11 million. It was not, there was very little interest. And as far as I know, it may have been John Bogle and most of his friends who took that position at that point. And he had to argue with the trustees to allow it to continue to operate, to give him a chance. What if they hadn't given him a chance? I mean, and that kind of luck, it happens all of our lives. And it's one of the things when I teach college kids, I'd like to talk about the randomness. And there they are thinking they know what their future is going to be. They don't have any idea. I never thought I was going to end up owning a company that distributed jewelry making equipment and supplies. I mean, where did that come from? I didn't know I was going to end up running a company that manufactured high-speed paper handling equipment. How did that happen? I thought I was going to be a stockbroker. And I found out soon after, having for 2 years, I went in and applied for that job before I even graduated from college, because I was hoping I'd go to work for the firm when I got out of college. No way, we don't want you. We don't want any kids. Go out and sell Fuller brushes and come back and see us when you're 25 or 27. And then when I went in the last time, they actually agreed to hire me just when I was retiring. But you know something, I might have had to go out and sell Fuller brushes for a while before they would hire me.
The role of the market is the valuation of assets. So what's your opinion if everyone or most of us would start invest passively? I mean, there would be only buy and holders. Do you think that the market would not perform or would perform poorly in terms of valuating the assets, or the market maybe would just stop working as expected because everyone would just only buy the whole index and do nothing?
Well, there's a lot of theory around this, because it is a consideration, and more I think today that over 50% of the money in 401ks are going into target date funds, where most of that money, whether it's at BlackRock or Vanguard or Fidelity, is likely in index funds. So that is certainly happening. But we have to remember that it is a relatively few shares every day that dictate the price at the end of the day. And so it is my belief that there will always be the folks who are going to be moving around, whether it's not necessarily day trading, but making those kinds of decisions when to be in or when to be out. So that's how our investments are evaluated. What is a little confusing is if enough money was going into index funds, that regardless of what's going on in the economy, that the market would keep going up and up and up, and so that is confusing. But my sense is, and in fact, John Bogle talked about this a little bit. He said that they had a real problem at Vanguard. During the late 90s, people were putting all their money, or a lot of their money, into growth. And when growth started fulfilling their dreams, they sold and they went to value. By the way, they went from the growth, when the growth had declined a lot, to the value after the value had gone up a lot. And so I don't know that we will ever change that aspect of investors and how they feel about losing money. We know that people don't like to lose money, but we also know the power of FOMO, fear of missing out. We also know the power of you only live once, and people wanting to spend money rather than save it. These emotional drives are huge. And of course, what I'm trying to help is one individual make good decisions. I want to follow the lead of Warren Buffett. I want to make sure you do the right things. There's only a few of them. And I want to make sure you don't do the wrong things. There are a million of them. And so I really want to focus on the right things. And then, and this is a big Buffett quote, don't say what's left over after spending. Spend what's left over after saving. If we can just get those two quotes down, we are on the way to helping young people build some really serious portfolios.
I'd like to ask you about buy and hold, the ultimate buy and hold portfolio. I'm developing here a software of mine which is just backtesting different portfolios, not only passive, also active, but there are like now over 40, let's say, passive portfolios. And what I like about your portfolio is that you can see a massive diversification in it. Maybe it's a bit overwhelming to someone who's really a novice investor, but what I like, it's really heavily, massively diversified. So if you could just tell us the philosophy behind the ultimate buy and hold portfolio. And also, by the way, just one more remark. What I liked is the steps you were showing, how you are building that portfolio, adding more and more pieces into it, and how it was influencing, how it was, had the impact on the performance. So I think that path is also very, very good to understand the whole process behind it.
And that article, by the way, that we update every year, Jack, about the ultimate buy and hold strategy, we originally wrote that in the 90s. And we've been updating it every year. And basically it takes about 10 minutes to update, because somebody has to run the numbers to see the implications of that series of decisions. First of all, the word ultimate. I am not pretending that ultimate equals return. I have no idea where the best place to put all of your money. If I actually had to bet serious money on it, I would say small cap value. Put everything in small cap value Or maybe I might say put everything in emerging markets small cap value. I mean, I could pick one asset class that's very risky and is likely to be rewarded for having taken that risk. But because I'm a defensive guy, I wanted to build a portfolio that included all of the asset classes that the academics said were likely to produce a premium for the risk that you took. And certainly, how many people have we heard that believe that it's hard to beat the S&P 500? And the academics show that the S&P 500 made about 5% more a year historically over bonds. So that's huge. That is huge. Every 0.5% should add $1 million to the value of your portfolio over a lifetime if you invest in a conservative way. You don't have to be aggressive. But I like the S&P 500. But then I see that large cap value is another asset class all by itself. You see, the S&P 500 is mostly growth. It's cap weighted, so those very big companies there represent most of the upside and downside movement on a day-by-day basis. It's not the little companies in the S&P 500. So what do I know? That let's call that more of a growth, but then there's this group of stocks that are out of favor. And the academics have taken the time to show why that is a different asset class. And it's amazing how different it can be one day at a time. The market yesterday, it was a bad day in the market, but not for large cap value. Large cap value made money yesterday. But large cap growth lost a bunch of money yesterday. So I say, okay, let's have some large cap value in the portfolio, but not a lot. Let's just have 90% in the S&P 500, 10% in large cap value. Does it make a difference? Well, I don't remember the exact number, but it's about 0.2% more return because I add 10% in large cap value. But then there's small cap blend, another asset class that actually makes more than the S&P 500 because it's more risky. And when you add that to the portfolio, it makes another approximately 0.2%. But what about the volatility? What's happening to the risk you're taking? Are you taking high risk when you add a little bit of this and a little bit of that? Turns out you don't, as a matter of fact. The volatility is about the same. And you keep doing this. Small cap value, REITs, international large cap blend, international large cap value, international small cap blend and small cap value, and emerging markets. You put 10% in each one. Remember, I said the smart thing to do based on the past was put everything in small cap value. But no, I don't want to do that. I think that's too risky. And so the portfolio is built to own all of them. And this is where John Bogle said, Paul, you're nuts. They aren't going to do it. And John Bogle is right. So what do? It turns out you get virtually the same return with 4 funds instead of 10. Those 4 funds in the US, large cap blend, large cap value, small cap blend, small cap value. You want to add internationals? Can do that with 4 funds too. US large cap blend, international large cap value. International small cap blend, US small cap value. About the same return again. Now you need to know, what ETF should I own to have those 10 or 4 investments? And we give them to you. Chris Pedersen has taken the time, an engineer by trade. I just interviewed him yesterday. His grandfather taught him to say when he was 2 years old, I am a financial wizard. That's what he taught him to say. and doggone it if he didn't become one. But he has taken the time to go through all of the ETFs to pick the ones, whether you're looking at 4 funds globally or the US or the 10 funds, so that you can build your own portfolio, and we don't make 1 penny.
You're also a big fan of the small cap value, and I saw some article there. I don't know if you had a chance to look at it, earlyretirementnow.com. And there's a counter argument that the small cap value, indeed, they are good, but when we are looking in the old history, then maybe the data is not of very good quality, or also maybe that that was working in the past, but it's not going to work now. I mean, to be honest, for me, I don't have a strong opinion on that. I think that we have to be just very patient, and the history showed that definitely what Professor Fama and Professor French were teaching us, that there is something in it. But how would you respond to that article, that there is maybe a party which is over?
Well, I know that well. That article was written after I had an interview with the folks at Choose FI. And when I say I was saddened by it, I was only saddened by it because I really didn't have a chance to respond to it. And by the way, I am sure the folks at Choose FI would have allowed me to if I had asked, but I thought if they thought it was important enough, they would ask me to respond. But here is the response. Daryl Balls, he's our director of analytics, another engineer, retired engineer from systems analyst from Boeing and manager. And he does some marvelous work. But one of the things he built was a telltale chart for small cap value versus the S&P 500. And what you will quickly see, if you kind of look just at the bottom line, is over the last 90 some years, the small cap value has produced about 14 times higher return than the S&P 500, which should not be a shock because small cap value is more risky. But what people are not ready for is that you have to be willing to live through periods of 10 to 20 years of, I'll call it underperformance. And the reason I call it underperformance is because for that 10 or 20 years, you basically end up producing the same return as the S&P 500. You did it and you didn't get a premium. But then the premium comes and has tended to come in very relatively short spurts of time. And this, unfortunately, is the problem that we have with any great investment asset class. I look, for example, at the S&P 500. Why aren't there studies coming out telling us that the expected rate of return of the S&P 500 in the future is going to be much less than the past? Because since the year 2000, in fact, from 2000 to a couple of years ago, the compound rate of return was about 5 or 5.5%. And like you mentioned, Jack, the previous 25 years, it was 17% compound rate of return. You know, what's wrong with this picture? Is there a change in the expected rate of return of the S&P 500, and that where we should be investing is in cryptocurrency? I mean, these are all decisions that investors have to make. And so when I say that I put my stock in terms of confidence in the academics, they don't hide the fact that there'll be long periods of underperformance. That's just baked in the cake. And there is not any asset class that has a long period of outperformance without going through these long periods of underperformance. And my challenge in trying to be an educator and help people make a lifetime decision for long after I'm gone is to convince them that there are a group, a small group of asset classes that are likely to serve you well. And if you're lucky enough in the early years of investing in those asset classes, that the market is in decline, that people are losing money, and you are buying up these asset classes at discounted prices, I'm sorry I'm not there to break open the champagne with you, but by golly, if I could, I would, because that's what you should want, rather than being scared out of it and concluding this is the wrong thing to do.
All right. So would you agree with that saying that no pain, no gain, that in fact the small cap value, in order to capture that premium, we have to go through the periods which, as you say, underperform in the way that we are not even losing money, but we are maybe on the level of the S&P 500, or we are not receiving that premium. So there will be such periods, and if there would not be such periods, then there will be no premium for that risk.
But and Jack, there's one thing more. Small cap value is fine, but most people don't understand that small cap value runs a range from very large small cap value companies that aren't very deeply discounted value companies to very small cap value companies with very deeply discounted value companies. It's like multiple asset classes within one asset class, and it matters. I look at what Chris Pedersen, in his best in asset class recommendations at the first of this year, his choice for small cap value is a fund that has been developed by a company called Avantis. And Avantis, so far this year, is up about 48%, while other small cap value funds are up 25 to 30. It's not magic. It isn't like they did anything special. They happen to build their portfolios on average in a smaller cap value company with more deeply discounted value, with a focus on quality of earnings. So it is an asset class in essence by itself. And so I want people, the reason I would like people to know about our work is it's not about me, it's about the work that Chris Pedersen has done to look at each one of these ETFs. They all have a reason for why they are built the way they are.
And by the way, I think that that people who are working in that company, who set up that company, Avantis, they are coming from Dimensional, if I'm not wrong.
Yes.
Where Professor French and Fama are also involved.
And that is, again, this is all going back to the academic community.
Yeah. So I have a question regarding the ultimate buy and hold, because there are people also who are gold bugs or are strongly believing in gold, or maybe even broadly in commodities. But I know that you are not fan of both. I mean, gold and commodities as a group even. Would you be able to just explain a bit why you're not a big fan of commodities and gold in particular?
Well, part of this, I guess, I would credit to Warren Buffett, and part I would credit to Dennis Tilley. Dennis Tilley is the gentleman who runs that hedge fund I talked about, and he gave me a lesson on commodities and how they're priced and what kind of return one should expect. Gold first. Gold. There are myths about investing. I've got over 200 of them that I've accumulated over the years. Will be eventually part of a book of 1,000 things you should know about investing. But the myth is that gold performs well when the market declines, and the truth is that really isn't where historically you want to be when the market's in collapse. The best place to be historically is in long-term treasuries. Now, I'm cherry picking that because I know that when the market collapses, there is a rush to something that is very dependable, has a history of being dependable. Gold has a history of being very volatile. It hasn't got a history of being dependable. As a matter of fact, it's many times more risky than long-term treasury bonds. And yet the return over the last 50 plus years is very similar. So if I am going to own bonds or treasury bonds as a way of hedging against the catastrophic, that is what I would look to rather than gold. Now, that doesn't mean there aren't times when gold acts the way that people in the gold industry say it acts. There will be times it does. I have the good fortune of having friends in the gold industry that I've known for many, many decades. I have never been with my friends in the gold industry that don't have the ability to sit down and in 5 minutes convince me gold is the place to be. It's like asking an insurance salesperson, do I need insurance? The answer is yes. This is the thing to do. And so I just want to be realistic. Now, the commodities, what Dennis Tilley convinced me and showed me, remember, I am but a salesperson collecting information from really intelligent people and then passing it on. But basically, the expected rate of return is treasury bills less expenses. Sometimes it will be better. Sometimes it will be worse. I mean, if you looked at the last, I don't know, 20 years, commodities have lost substantial amounts of money. I don't have that right in front of me. But again, if I'm looking for something to act as an asset class that will to create stability during a declining market, I'm much more comfortable with long-term bonds. Having said that, I don't sit on long-term treasuries. I sit on short to intermediate and tips. The reason being is that I don't really look to these assets as a protection against the catastrophic so much as just to bring the volatility down. And the thing about long-term treasuries is when we have a big rise in interest rates, those long-term treasuries are going to be hit hard. Whereas the short to intermediate historically have very small losses during periods of rising interest rates. So it's always this interesting decision. In the 12, that book of We're Talking Millions, if you look at what I've done, I've taken you to a fork in the road, stocks versus bonds. What are the implications? How about mutual funds versus individual stocks? Why would I go one way or another? Index funds versus active management. Roth IRA versus regular IRA. There are forks in the road, and what I try to do to make it possible to think through these maybe hundreds of decisions that we make is I take them one at a time, and I look at the implication of each fork in the road. And then I think, if I've got to do 200 of them, okay, I'll do 200 of them, but they'll really be based on each one being an individual, carefully, unemotional decision that seems right from everything I know about the past without a conflict of interest.
And by the way, regarding commodities, before our interview, I checked the S&P Goldman Sachs Commodity Index, and in the last 50 years, the maximum drawdown was almost 90%. So because you compared this to bonds, so that's, I mean, the volatility and maximum drawdown was just terrible.
Now, Jack, I got to ask a question. You got me all excited here for a second. Are you saying your database has that information in there?
Yes, correct.
Wow. I know you're here to interview me, but can I just ask you, because I know that some of our listeners are going to be interested. Just give us, please, a handful of the databases that you have in there that go back a long time for people who like tracking that stuff?
So for major indexes, the data is going back even to the beginning of the 20th century. For things like, for example, commodities, it's like around 50 years. But most of the passive portfolios, if you build them in that software, you can backtest them for up to 50 or even 100 years, or even more than 100 years, which
Do
is,
you
I think,
reinvest the dividends?
Yes, of course. Yes. So of course it's including dividends. So it's a total return. So I think that looking into such a long history is giving us a lot of information about the markets, and it's a great way to learn about the markets and about our expectations to set them on the right level. And you mentioned, for example, now the bonds that you are more in the short term or intermediate. Yeah. And in fact, yes, for like 40 years we had a period in which bonds in real terms were giving us the negative returns, and that was 40 years period from 1940 till like 1981. So there's nothing new, I would say, and just looking in such a long history, we can learn about it. And by the way, regarding this commodity index again, I think that it's so much popular among investors. It's because it's so volatile, and sometimes we can see in the news that it just is giving 100% return in the last 2 years, but this is just 2 years. But if you look on the really long term, in the 50 years time, you see that bonds are giving the same return with a much lower risk. So
I can also ask, Jack, are your figures both real and nominal? You show both before and after inflation?
I have also nominal. So I mean nominal, and then I can also adjust them to inflation. So you can see how they look in the real terms after inflation adjustment.
And one more question. Do you have monthly data, or is it annual data?
So I have monthly data, especially the data which is going back decades. But for the last 20 years, I have also daily data. But the data which is going really very far, it's a monthly data.
So for people who are watching this, who are interested in looking and maybe even testing this kind of information, is your subscription? The thing I noticed, it's Windows based. Is it also available somehow for Mac?
Unfortunately not. I mean, you can run it on Mac, but you have to use, like, for example, Parallels Desktop, which is kind of running Windows on top of Mac. So I think that this is indeed a bit of problematic for those who are on Mac. Although I'm personally also a Mac user and I can run it on Windows. So it's for people who are really willing to have access to that. Even if they are on Mac, it should not be a obstacle which is not solvable. So I think there are ways to go around it.
So then I have to ask, what is the shortest period of time? What does it cost for a year to have access to all this?
So currently I have 2 plans, for 1 year and for 2 years, and the price for 1 year subscription, it's $179. So basically then you get, for the whole year, you have the application with all that historical data, plus you have access also to over 70 exchanges around the world with the current data, and also with the history going back to 30 years, daily data, here. So basically, from wherever you are located in the world, you can build a portfolio. And also, what is, I think, interesting for people who are not maybe living in the United States is that you can build a portfolio, and then you can see how it was performing in other currency. Let's say like in Europe, you can see how it's performing in euro.
Wow.
If you are in, let's say, in Canada, in Canadian dollar. If you are in Japan, in Japanese yen, for example, so that you can see how that portfolio was, because there are differences, of course.
Yes.
If you buy even if you have a global exposure to the stock market, there is more than 50% of United States, but there is still like over 40% of other different currencies, so that portfolio will perform differently in different currencies. So you can check that as well. So I think to me, I think it's good for both purposes: the educational, and then also if you want to do the practical exercise and just do your homework. If you are do-it-yourself investor and you want to do your homework properly, not only by reading the theory, but also just doing a real exercise, I think it's a great way to do so, because you have in one place everything you need. And obviously someone can say it's just only history, but that's what I wanted to ask you. How do you see that? That quite often I see people are criticizing that well, it's great tool, but it's just only telling us what happened, but what will happen. What I'm answering to these people is that, oh, well, I mean, I'm sorry, I don't have a data from the future yet, but I wish to have. But I don't think that investing is about, predicting the future, because no one knows the future. But the history is really telling us a lot. And I'm just wondering how you see that thing about backtesting, because it's very easy to criticize it, because people are saying that now this time is really different, and they are telling this, I believe, always. Probably when you were starting in the 60s, people were also saying that this time is different.
Always. That always is what they say, Jack. And my view is this, that as an investor myself, I want to know what are the range of returns that I should expect. Now, the problem is I am 78 years old, and I'm trying to make some sort of a judgment about the return that I'm going to get for the next 10 or 12 years, let's say, if I'm lucky to live that long. And there's nobody that can tell you, but I can tell you this. When I look at every 40-year period, and Daryl has got this information together for us, every 40-year period with the S&P 500, the average return was about 11%. Now, that's much higher than we normally think, except that when you look at all the 40-year periods, you quickly, when you start in 1928, you quickly get beyond the early 30s, and they no longer are part of the 40 years, and all of a sudden the return looks better. But I'm okay using the 10% as the expected long-term return, but I also know there's a chance it could be better. But I also know that the worst 40 years was 8.9%, and the best was 12.5% for the S&P 500. Now I want to know, what do the worst losses look like? Well, I know from history that there's a calendar year that I would have lost 43% on the S&P 500. There was another year I would have been up 54%. I can know all this stuff. And is there a value to it? Well, let me just give you one example where I can say, I told you so. And that is 2000 to 2009. The S&P 500 compounded at a negative approximately 1% a year. It had two bear markets, substantial bear markets that took 50% of the value of the market before it recovered. And the compound rate of return from 1930 to 1939 was, or 29 to 38, I guess it is, was actually a little better. In other words, they'd already, if they believed, I've been showing them these periods looking backwards and saying, that's coming, folks. I can't guarantee you that's coming, but it's coming. And people are, well, that's not the same. You know, we have the SEC now, and we have the Investment Company Act of 1940, and all these reasons, and more people are involved in investing, not just a few people. Turns out, even with all those things going on, the loss was substantially the same as it was back in that period during the Depression. And that, to me, is helpful, because then I can also take that period from 2000 to 2009 and 1929 to 1938 and say, what if I had $1,000? What was it worth at the end of that period? What if I only had $100 a year to put in over that 10-year period? What did that look like? There are such huge lessons, because, as you know, when you put $100 a year and you dollar cost average into that terrible market, you come out with a big win, not a big loss. So I do believe those old numbers have a lot of value, but I also know this. It's kind of like, I recently did an article that had, and a podcast in December of 2019. I did a podcast that's had almost 500,000 opens. And the title is The Number One Reason to Buy Index Funds. And basically what I say on the podcast is that if you buy index funds, you don't have to talk to a salesperson ever. And that can pay huge rewards over a lifetime. People just don't know how big those rewards could be, because if they buy the index fund and they never talk to a salesperson, they never know what might have happened had they talked to a salesperson or loaned money to their uncle. But the same thing is true of looking backwards versus people who claim to see the future. I don't trust people who claim to see the future. I don't mean that they aren't trying their best to put a whole bunch of variables together and tell us what's going to come out of that. There's big money to be made selling that kind of information to folks. I understand that. But is it possible you would come to a conclusion that is totally unmoved by what really happens? Because what really happens is the random thing we didn't expect, like a pandemic. And then the pandemic turns out to be good for the economy rather than bad. I mean, go figure all these things that happen, and then ask, am I better understanding the past and the nature of market movements, or do I look to some guru who can see into the future? I think they're con men and women. By that, I only mean they con themselves. They don't con me, because they don't get to me. They are conning themselves. But I also understand that the nature of the human being is we make up stories about everything that happens in our lives. And it turns out that very few of the stories we make up are even true. So that's kind of how I feel about the past versus some sort of an evaluation of the future. I trust the past. And by the way, I trust the fact that the academics looked at it, not that they waited for me to get to it, because I was not qualified to get to it.
For example, to me, very surprising was when I looked at the results of the market during the Second World War, because you mentioned the COVID-19. When I looked at the data from 1939 till the end of 1945, we could expect that it was a nightmare for the markets. And in fact, yes, there were countries like Germany and Japan where the markets, there was like over 90% drawdown. But in total, the global markets, if you would look on monthly basis how they performed, it was really, you wouldn't, and I would just not show you the years, yep. You wouldn't tell that it's during the Second World War. As Winston Churchill was saying, it's business as usual. I mean, you wouldn't say that it was during the Second World War.
And it makes sense, does it? I mean, this is one of the challenges. We want to make sense out of something that doesn't care about what we believe. And the one thing that I've been teaching for 50 years, there is no risk in the past. We always know what we should have done. And it makes it look like, well, if we'd only done that one thing, we would have done well. In my case, I have a friend who basically has or had almost all of her money in Microsoft. There's a reason why she ended up with it. It wasn't exactly a pleasant story, but she ended up with it. And that made her super rich. Coca-Cola did that for people in Atlanta. But just because my friend got rich on Microsoft or Coca-Cola people, it doesn't mean that investing in Washington Mutual in the Pacific Northwest, which is went out of business, is a way to get rich. So that looking back, we got to be careful, because you can look back in a good way and you can look back in a bad way. And the bad way is the way that misleads you to come to conclusions that are more myth-based than reality-based.
All right.
By the way, Jack, because I know you're going to cut me off here in a minute, I really want to ask another question about your service.
Sure.
It seems to me when I looked at it, you also include some market timing systems within
Correct.
the software that they get.
Correct. Currently, I have two systems there. One, I like very much the momentum anomaly, which is a kind of a trend following. Mm-hmm. But here, one of the system is based on ETFs. So basically, you can switch between stock or bonds as a when the markets are going down. And this system is based on one of the guests I had on my show, Gary Antonassi, who's a great researcher on momentum anomaly. And another one, it's I would say more aggressive, where you are basically, rather than, for example, buy momentum ETF, there is a system which is just making a ranking of stocks with the highest momentum, and then you rotate it like quarterly or monthly. It's very flexible, so it depends how you want to do it. And there is also risk parity, so it's pretty advanced system. But the whole thing is that it's all algorithmic. It's just you don't put any discretion in it, and you just follow it. You can backtest it, and then you have to stick to it. But I fully agree that we should avoid torturing the data as well. So I'm a big fan of mechanical approach, but also simple approach, because people, I think they have the feeling that if there is more moving parts, the strategy is probably better, which there is a higher risk of,
I agree.
curve fitting, for example. Yeah. But yes, you're right. It's not only the software. It's not only about the passive approach. There are also active strategies, and the more are on the way. So I'm still developing that. So there will be more on it. And to be honest, I personally, as I said, I do appreciate the buy and hold, although maybe it will change over time when I will be older and older, but now I still have majority of my personal capital under the active strategies, but they are 100% systematic. So I'm not a good discretionary investor, if you would ask me. I'm a terrible advisor.
So I get a lot of questions out of folks in Europe. It's not huge, but enough that I feel like I should be figuring out some way to respond. They are people who want to take, for example, our 4 ETF strategy, and they want to be able to somehow do it in Europe. Is there anything about what you have in your program that would help people do that in Europe?
Yes, it can actually help everyone wherever they are located, because you can use, so first of all, you can use the historical data before the era of ETFs. So then you can cover that period in the data which is built into the application. And then on top of it, you can fetch the data for specific ETFs. And as I said earlier, I have access, and it's part of the subscription, access to over 70 exchanges over around the world, where you get access to the daily data for these stocks or ETFs or mutual funds or whatever. So basically you can build it, and you can even convert it into your local currency, so that you can see if you are living, let's say, in Turkey, and there is the Turkish lira is really now having a very, very volatile time. Then you can see how just investing globally can save you from being in such a volatile market as Turkey currently. So I think that even if you are in Europe or if you are in the United States, obviously in the United States, the problem, for example, in Europe is that most of the European investors, they don't have access to American ETFs by law, by regulations. So they are forced to basically use the ETFs which are listed on the stock exchanges in Europe, like in London, Amsterdam, and so on. But this is just a specific for European investors. But if someone is, on the other hand, living in the United States, then there's also no problem with that software. You can just use the ETFs you have in the United States. But the data before the era of ETFs it's I would say universal, so no matter. Yeah, so I think it's pretty powerful.
Sounds like you're building a really neat business. I'm going to ask you a really personal question, and I know you can cut it out if you want. I started my company with $15,000 and a whole bunch of sweat equity, and I have to ask, what did you start your company with?
Actually, the major investment was my time.
Yeah,
that was my major investment. Okay, I'm still working as a software engineer in some commercial projects, so I just had to reduce the number of hours working there because I wouldn't have enough time on my project.
Yeah.
But I can tell you that this project was mainly done by my personal effort. Now I have someone extra working with me, helping me with that.
Great.
But it's really, I would say, low cost project.
Yeah. That's great.
But I see it like a way to go. I mean, rather than investing a big bunch of money, I'm starting just putting just mainly my effort into it. And once I will see it's taking traction, then I can invest more into it. I'm quite also I would say defensive here. Maybe I should be more aggressive in terms of running a business, but that's how I see it. So yes, I didn't put a lot of investment into that in terms of money, mostly my work.
And now, are you a married man or a single man?
I'm a married man, so with the 2 kids already. So
oh my gosh,
yeah.
You gotta
But
be careful, because I just tell you now, you've asked me a lot of questions about my past, and I can tell you there's some risk in being so passionate about your work that other people want some of that passion for them. I hope you're better about that than I am, because it really is a trap for people who are so involved in their work. I wish.
But I'm happy to have a very wise and smart wife, because she understands me, and I think that it's really we are just a great couple. So I think that it works perfectly. But I think that she understands that I'm very passionate also. So she understands that I work maybe more than an average person, but I love what I'm doing. So
great.
It works fine for us.
That's great. Well, I do wish you well. Do you have any more questions for me before I go down and see my wife?
Yes. Sorry. Yeah, I know I was keeping you. I'm not going to keep you here for ages. Yeah, we are talking like almost 2 hours. So sorry for that. So let me just ask you the last question, or maybe just 2 questions. Last question. Today, when I was running in the park, I was listening to your podcast about cryptocurrencies. And quite often and just a disclaimer, I'm not investing my personal money into cryptocurrencies, although I'm still pretty young. I just overlooked that opportunity. I don't know, but I'm still very old-fashioned in terms of investing. That's my personal view, although I'm not discouraging at all fully that you cannot put any money into it. But I wanted to know your approach into that. For example, quite often I get a question from other people: what if I would put 5% or 3% into a cryptocurrency? So I'm not going to put everything into it. Although, as I heard today on your podcast, there was a person saying that she doesn't want to invest on the stock market because it's too risky, and she put everything into the Bitcoin.
Well, the only money she ever put at risk was into Bitcoin. She didn't put everything. If I said everything, I overstated.
But at the same time, saying that stock market is risky. So how do you see that personally? 3-5% in the portfolio. Do you see it as a reasonable or not?
Well, that's just whether it's Bitcoin or individual stocks. The question is, people say, well, can't I have some play money? And my answer has always been, because I don't have any money invested that is play money, not a penny. It's just there to do the best it can for our family and the charitable causes that we care about. So I don't look to investing as a way to prove anything or to buy more, to live a higher lifestyle because I hit a home run. I say that if you know you're not going to need that money later in life, if you know that, and the problem is we don't often know that, people who have lots of money. In fact, I think about people who are buying art and paying millions of dollars for, in essence, what is digital art, and so what am I to do with that? You know something? I don't care. I mean, they can have all the games they want. They can have the biggest yachts. They can fly to the moon if they want. It had nothing to do with my life. But I have to ask the question, for people who are going into cryptocurrencies, is there in fact a likely value there? I had a great interview yesterday with Chris Pedersen, who retired from NVIDIA. I think I'm saying that right. And he was fortunate to have worked at NVIDIA, because that obviously is been a really good investment, et cetera, and is involved in the blockchain part of this whole story. But he agrees that you can't say there's a value. You can say that there's a price people will pay, and that, in fact, the academics will say about the price of a stock, that the value of the stock takes into consideration all of the known information. And I guess at some level, you could say the same thing about cryptocurrency. But just because a stock sells for 1,000 times earnings, you're not likely to get Warren Buffett to put any of his money into that company, because he would not likely see the value that he's looking for. So can you go to Las Vegas and gamble? Can you go online and gamble on football games? I've talked to a lot of young people who have put money into cryptocurrency, and I ask them enough questions to know they don't have any idea what they're invested in. And yet, what do I hear? I hear from the experts, don't invest in things you don't understand. All right, let's say that that's a good piece of advice. What do I do then when somebody asks me to explain cryptocurrency? Now, as you know, Jack, I punted on that, and I read from articles that I found that I felt represented something that gave some meaning to the whole cryptocurrency. But I walked away not believing that there's any value there. Having said that, coins used to be, shells used to be money. They were money. They were just as good as $1, a shell off the beach. What's that about? Well, it's about a different time, evidently. And I know, for example, that if you own some Confederate bonds, it's hard to cash them in and get the money back for those Confederate bonds because they're gone. And what are there? 100 plus cryptocurrencies now, right? I've seen some number. It's a lot. And will all of them survive? I doubt it. But not all the people that started companies to make cars survived. So it's hard. And so my belief is that I'm going to continue to give advice where I can somehow identify a value, and to encourage people who have invested in those mutual funds or ETFs to continue to hold them during the ups and downs, even though there will be points that it will be easy to say, seems overvalued to me. And there'll be points where it'll feel like, oh my God, I know it's going to go lower. That those responses, emotional responses, even though intellectually they make sense, I have been hoping that people will be able to override them, because the history is they don't do well trying to market time their emotions. But I worry for the young people who are going to likely blow a lot of money with the cryptocurrencies at some point. I'll just share one other thing. People, we know what Bernie Madoff did was he created a Ponzi scheme. Lots of people know they're in a Ponzi scheme. This is a fascinating part of this. They know they're in a Ponzi scheme, but it is their intent to get out of the Ponzi scheme while the getting is good. And I suspect that many of the people who are in what may end up to look like a Ponzi scheme in the end, I don't know. I honestly don't know. That they will just be late to get out because it's hard to pull the plug, particularly when you become a millionaire. In fact, some guy put in $8,000. I don't know if this is real or imaginary, and now it's worth over $5 billion in one of the cryptocurrencies. I faced that very same problem personally. It wasn't with 18,000. It was with 15,000. It wasn't $5 billion, but it was enough to sell my company and have enough to live for the rest of our life. And others could go on. I could pass the baton of risk to them, and they could hopefully do well with it as we did well with it. But it's the same thing. At what point do you say enough and you pass the baton when you have been lucky? How many people who win a lottery blow it? Supposedly, most of them. I don't know how they do it or why they do it, but they do it according to the experts. And I think, boy, when you have that one chance in life, it'd be nice to be able to capture that value, not only for you, but for the people who survive you and the charities and folks, the causes that you believe in.
Yeah, thank you for that. All right, so really the last question, and I know it's like 2 hours now, but really the last one, and I think it should be the easiest one. As you are the author of many books and numerous articles, what do you propose to start with for a beginner investor? Because when I came to your website, there's so many, materials, so maybe someone can feel overwhelmed. So if you could just give a path to the beginner investor from what to start.
Well, there are three books in theory that are for the beginner investor on the site that are free. The one that I would probably recommend is We're Talking Millions, 12 simple ways to supercharge your retirement, understand that each of those 12 ways is $1 million decision. Now, does that mean that if you do those 12, you could have 12 million plus? Absolutely. Does that mean you have to put up millions of dollars to get there? No. But it will give you the basics. And in the second half of that book, I talk about 2 funds for life in a very simple way. Now, Chris Pedersen has just published a book. All the profits go to our foundation. It is entitled 2 Funds for Life, and it's a 280-page book that goes into so much detail. I just think it is an absolutely wonderful book, but it's for people who want to take the time to dig and understand, because it's a lifetime discipline and worth understanding. We also have a book that's free entitled 101 Investment Decisions Guaranteed to Change Your Financial Future, as well as another book for first-time investors. Those last 2 books are going to be updated in the coming 4 or 5 months. They were written when we started the foundation, and we have not updated them, but they're about to get an overhaul. But those 3 books ought to give you a lot of what you need. But the book of 12, boy, when you think that there are 12 things that could lead each to $1 million, that's worth reading and hopefully taking it seriously. And of course, as you know, Jack, we have, I think, 700 articles and podcasts, lots of videos. And for the people who are old timers and trying to figure out how to make the last part of their life work financially, I made a video for 10 people. In the old days, I would have walked in, this is pre-COVID, I would have walked into the Bainbridge Island Senior Center and I would have made my presentation to 10 people about my favorite 12 Vanguard funds for retirees. But instead, because I couldn't do that, we did it as a Zoom presentation. And then just for the fun of it, we put it on the internet. And we have had over 100,000 views of that Zoom presentation. So we're doing work for old people as well as young people. I've got to be there to help my friends that are the same age I am, and boy, I'm rooting for them. So I hope that I'm being of some help to your young followers, Jack, and I suspect you got some middle-aged followers as well. I am excited about sharing this interview with our podcast listeners. We may have to break it up into 2 parts, but only because, also because I want them to know about what you're doing. We have a lot of people who write to me wanting to know more about market timing, and I gently put them off. But you've done just a ton of stuff that I think will be of value. And I also think you're going to hear from some of our folks who are serious buy and holders who want to dig into more of the history, not just of the areas that we cover, but you're doing some other stuff that we don't touch on that I think they'll find of interest. So I wish you well with your program. We'll have a link when we write up the podcast to your site. And I wish you all the best with what you're doing. And again, thank you for having me on as a guest. I do appreciate it.
Thank you, Paul, very much for your time and for being so patient with me for over 2 hours. And big apologize to your wife. And by the way, I will send her the part of the video before we were recording it so that she can hear about your English as well.
You're a man of your word.
And by the way, I encourage everyone who's listening to us to visit my website. So in the show notes, I will put all the links to Paul's materials, to his books, to his website, paulmerriman.com. That's your website. So I will put all the information there and all the materials you mentioned. So I think it's a great reference, and it's a great source of valuable. And I think also the problem in the investment area is that there are people who are also, some charlatans and stuff like that.
Yeah.
And here you are really the best quality knowledge, and I think it's a great value. So thank you so much, Paul, for your time. It's really highly appreciated. And have a good day. Thank you.
Okay, bye-bye.
Take care. Bye-bye.